My name is John Gupta. I am the leader of Eide Bailey's state and local tax practice within our National Tax Office. Really happy to have everybody here today. I am coming to you from Boulder. With me today are two of my esteemed colleagues, also in our National Tax Office SALT group, Jennifer Barajas. She is a senior manager focused in income franchise. And we also have Crystal Schultz, who is also a senior manager who is focused in sales and use. I am going to walk through a few topics here, and then I'll turn it over to Jennifer, and Crystal will bring us home. So have a lot of material today to go through, and so let's get right into it. So our agenda for today, we're going to talk just a little bit about the state of the states, and then a update on the state pass-through entity taxes, which is really probably the top topic in the state and local world right now. So decided to spend a little bit of extra time on that. I'm going to focus a little bit on some trends in state income tax nexus, and then just some additional developments both in the state income tax world as well as some trends on the sales tax side. So I always like to kind of start these with a state of the states, and I think it's important to kind of get a little context about the budgetary and political posture of the states, because that really is a good way to kind of animate or a good way to anticipate rather some short-term trends and what the states might do from a policy perspective. So last summer it was very different than where we are now, but last year we were in a place where the states were really awash in cash. And one thing to kind of keep in mind when we're thinking about states, very unlike the federal government, the states have to balance their budgets. So we typically look at how a state is doing from a budgetary standpoint based on whether it's in a surplus or a deficit. Last year, almost all of the states were in significant surpluses. A couple reasons for that. The anticipated tax revenue declines from the pandemic never materialized. The state revenues actually stayed very strong during the full course of the pandemic. And then also the states had a significant amount of cash from the federal government from the American Rescue Plan, ARPA, where $350 billion was earmarked directly to go to the state. So as an example, last year, California had a $15.5 billion surplus. And on top of that, they got $43 billion in federal funds on top of that. So really a lot of money swishing around at the states last year. And the politicians kind of were falling all over themselves to return that money to the taxpayers. We had a lot of tax cuts across the states. That really was kind of the common trend over the last couple of years of money coming back to taxpayers. And then also, the states also kind of built up and preserved some of those funds for rainy day. So some of those funds were preserved for that purpose. So let's fast forward to now. A little bit different of a picture. There are growing budgetary threats. In fact, we do have several states that, including California, which I just mentioned, who are now in a position where they're looking at deficits. So what's happened? Number one, the federal funds have been turned off. Those are not coming anymore. The states, as I mentioned, really across the board engaged in a lot of returning money to taxpayers through tax cuts. And then also, as we all know, we're kind of looking at the potential for a recession or at least a slowdown in the economy. And the state taxes are very, very tied to how the overall national economy is doing. So we don't have specific numbers yet on where the surpluses budgets are, but we do know that in April, total state tax collections were down 25%. So that's manifesting kind of what we're seeing, a pretty significant slowdown. But we are seeing a very significant divergence among states where some are still very strong and others are kind of weakening. The ones that are strong tend to be those that aren't reliant on an income tax, but are more reliant on a sales tax. And while financial markets have definitely weakened, consumer spending is still very strong. So sales tax Those states that are really reliant on that and more focused on that are doing great. But those states that rely on high income taxes, your Californias, your New Yorks, because of financial market weakness, and also because coming out of the pandemic with the remote work trend, it's much easier for people to move around. And we have very clear evidence that people are moving and moving based on relative tax costs from places like California, New York to places like Florida and Texas. So that trend is definitely happening. And so it kind of an interesting divergence among the different states and how their taxes are focused. So.